So you want to start your house hacking strategy to invest in rental properties? Well, the FHA loan probably is your best start. I'm going to talk about a great way to begin using an FHA loan as your primary loan strategy to acquire rental properties. So we're going to give a lot of good tips and tricks along the way. I'm going to show you an example or two. So stick around all the way through the end, and we're going to kick this rodeo off right now. Hi, I'm Kevin Fagan. I'm your mortgage patriot here, nestled in the beautiful hill country of Texas, serving proud Texans as well as others across the country. So do me a favor, please, and hit the like and subscribe button below. So let's talk about FHA loans and how that really is a great starter loan to get an investment property. So first and foremost, up front, understand this. FHA loans are only for primary purchases, meaning they're only for the house that you must live in. It has to be your primary home. That's the only way you can get an FHA loan. So why are we talking about FHA loans with respect to investment properties? Well, I'm going to explain that for you. Let's take an example of a duplex. If you're buying a multiple unit property, which FHA allows you to do, then you can live in one side and rent out the other. So FHA allows just purchases of multi-unit properties from a single family home to a fourplex. So you can get a duplex, a triplex, or a fourplex, a quadplex, and still enjoy that very low 3.5% down payment. So let's take an example. So a $200,000 duplex, you live in one side and you rent out the other. The down payment for that under a normal circumstances in a conventional loan would be 20%. 20% of $200,000 is $40,000. $40,000, that's a pretty good chunk of change to come out of pocket for, plus closing costs. Whereas in an FHA loan, you're only putting 3.5% down for that entire duplex. So 3.5% down of $200,000 is only $7,000. Compare that, of course, to $40,000. An enormous advantage as a starter in the first couple properties. It's a great idea to come out of the gate with an FHA loan because you're coming out of pocket for so small an amount. Let's drill down a little bit into this example and really examine the numbers and see if it'll work for you. Let's take the example again of a $200,000 duplex purchase. In Texas anyway, I can find this type of property with rents of about $1,050 per month. So in our example here, we're showing gross rents of $1,050 per month. Since you're only living in one side, this is your primary home because it's an FHA loan. You only have one more unit available to rent out. So in our example, your gross rents are $12,600 for the year, $1,050 times 12. Now, operating expenses. In the case of a duplex or any kind of investment property, there are operating expenses, including property taxes, which is probably your main expense, hazard insurance, the property insurance itself, minor repair work and maintenance, utilities. Sometimes those utilities can be included in the rent, but utilities and like items. In our example, we're going to use a pretty appropriate factor, I believe. So we're calling it $600 per month. This leaves you with a net operating income of $450 per month. Now you have the mortgage expense itself. Since we're using an FHA loan, today's mortgage insurance premium factors, and I'm getting a total of $1,425 per month. So what is your cash flow on a monthly basis? It is $975 negative. That doesn't sound like a good deal, Kevin. I don't know why are you talking about this? Because now you own a property you're only paying $975 for, which is kind of your portion of it. And a lot of it is being now carried by one of the tenants, your tenants in your second unit in this case. So $975 per month to own a duplex while you're gaining equity and while you're writing off other factors is not a bad deal to start off. And here's where the hack and the magic starts is after the first year. So remember I told you that you're allowed to move out after 1 year. And now look at your gross rents. They've doubled because now you're renting out both sides. So your gross rents have gone from $1,050 to now $1,100. We're assuming a small increase from $1,050 to $1,100. And now we're multiplying that by 2 because now you have both units available for rent. Your gross rents have jumped from $12,600 to $26,400. Now you're starting to cook a little bit. Let's look what those numbers look like. Your operating expenses are virtually the same, increasing them $50 per month for maintenance items and for property tax increases. But basically, they've been relatively in line. So we've increased those from $7,200 per year to $7,800 per year. So let's look at what happened to your net operating income. Your net operating income has exploded from $450 a month to $1,550 a month. Let's look at the last factor, your mortgage expense. Your mortgage expense hasn't changed, right? It's still $1,425. You're clicking along at that same pace. So subtracting that mortgage expense out of your net operating income, and we have a net positive cash flow of $125. Now, I don't know if that's going to set the world on fire for you, but again, let's talk about this. You now own a duplex that is basically carrying itself. It's paying for itself and giving you a little bit of spare change at the end of each month while you're enjoying equity growth in that property. Now, we're going to talk about some other ways to maybe increase those rents and maybe even lower expenses over time. But after just the first year alone, you are now annualizing at a pace that gives you cash flow. It's a set aside asset, meaning it's a passive asset now, and you have the opportunity to start this machine over again while you control that original duplex. And this is how you use an FHA loan out of the gate to really house hack and start your investment portfolio. So I promised you at least one very, very good tip. The FHA 203K renovation loan. What does it do? Well, think about this. What if you're looking for a duplex or a triplex, what have you, and it's quite beat up? And meaning it needs quite a bit of repair. Rents are subsequently very depressed because it's bad condition. And you don't have the money, obviously, to come out of pocket. It's tough enough to come up with that 3.5% plus closing cost. Let's take an example. Let's go back to our $200,000 example. We're buying a duplex. But now that $200,000 duplex is beat up and the market rents are about $1,000. But you know that the market in that area would support $1,200 rents if your duplex were up to standards, up to current upgrades and fixes. So an FHA 203K loan allows you to purchase the home and add anything up to, say, $30,000 of repair work and have that money rolled into the note. So I'll say that again. You can use a FHA 203K loan, a renovation loan, to purchase the property and to basically finance your out-of-pocket renovation costs. And you still would have that 3.5% down scenario. So in our example, we have a $200,000 house and we're adding $30,000 worth of improvement. On $230,000, you're still only coming out of pocket for 3.5%. What an incredible advantage. So now that $30,000 goes into a side escrow account, and that would pay contractors to come and fix the property. And once that property is finished, now you've gone from $1,000 or less in rents to maybe $1,200 in rents. So you've increased the value of that property and you haven't had to pay for it out of pocket in the least. So it's a giant hack, if you will, a giant advantage of the FHA programs. Again, the 203K renovation loan. If you have any questions, any comments, you want to potentially start an FHA loan and don't know how, if you want to know more about the renovation loans, you want to know about FHA in general, book an appointment if you like. We can talk for 5 or 10 minutes. I get that all the time from people. So I really do look forward to hearing from you and solving your problems or helping you get into the investment game. I'm the Mortgage Patriot here, Kevin Fagan, on your side, and make it a great one.